Okay, welcome to the Wall Street Crossover Show with myself, Zach Meir, and Craig Drake standing in for Darren Sinden, even, of Admiral Markets. Right, chaos yesterday. I obviously shouldn't stay away from Tip TV because whenever I go, the markets go mad. But today, any more stability today?
Not really. With kind of Greece, as we go now at the moment, Greece is still kind of fighting over a last-minute kind of compromise agreement that's been tabled, which will allow them to repay part of their debts and avoid complete default, because we've got the IMF deadline that's kind of rapidly appearing this afternoon. And it's quite interesting when you look at what's happening in the markets. Yes, markets are down. Yes, we've got volatility, but the markets are still not pricing a Greek exit. What we're seeing at the moment is a long way short of what we would have if people genuinely thought that Greece is about to leave the Eurozone.
So you think that this is still a denial? We're still in denial in terms of what could happen?
I personally think that Greece is most likely to stay in the Eurozone. I think by the end of this year, Greece will still be in the Eurozone in some way, shape or form.
They want to be in the Eurozone.
However, if they do leave, I think the risk of them leaving is at risk of being mispriced. I think the reaction at the moment could be a form of complacency, and I may be part of that complacency. But I think if you look at market reaction at the moment, we've had single-digit drops for the most part. We've not had any huge kind of panic in real terms, and so I think at the moment people are expecting something to be pulled out.
But haven't we had like the nightmare announcement? But I think the Greeks want to sue the EU.
Yeah, but the Greeks have said.
Would they qualify for legal aid if they?
Yeah, well, yeah.
But I mean, I'm just saying it's that it could really unravel badly in the sense that it's not one thing or the other, and it's just a state of chaos.
Yeah, but I do think ultimately we have seen in the past we have come down to we've been at the 11th hour for the last 4 years. Yes, we may be closer to the 11th hour right now. But I do think that ultimately the ECB will step in and the institutions will step in to bail Greece out.
Okay, well, let's have a look at what you've brought to us for this morning.
Yeah, I mean, we had, just to kind of avoid the Eurozone a bit, and so German retail sales were fairly kind of robust. They increased 0.5% in adjusted real terms in May. I mean, the issue with lots of these kind of numbers coming out at the moment is not necessarily retail sales, although they are affected by kind of climate within the Eurozone. What happens in Greece may not actually affect the German consumer, but that sentiment does. But most of the sampling periods for the data that's coming out at the moment in terms of business confidence, in terms of consumer confidence, in terms of retail sales are sampled before Greece really started to kind of implode. German employment rates, etc. Italy kind of held at 12.4%, which is obviously still kind of astronomically high. But there was hope that they were going to see the gradual kind of decrease in that Italian rate. We've started to see an upswing in kind of business activity in Italy. We've started to see that that kind of business activity pick up. And, after we had such a freezing of credit, we had a freezing of loans to businesses, and now we've got huge amounts of cash being pumped in there from QE. We've started to see that, but it's not really feeding down to that upswing in employment rates. But we saw in the UK, we saw in the US that there was quite a significant lag between uptick in kind of business activity and getting rid of some of that slack in the jobs market. Actually, the big headline one for the UK, and it's kind of David Cameron's probably quite glad that we're not having the EU referendum anytime soon, given that current economic data is kind of making the case for him. We've got robust growth in the UK. We've had GDP growth revised up to 3% after the previous reading of 2.8%. We've seen gross fixed capital formation up by 1.5 billion. It's the highest since the ONS started recording that in 97.
Yeah, but doesn't that imply that things could? If we left the EU, what would GDP be? 7%, 6%? It looks as though things couldn't actually be any better than they are, even though we are semi-detached in it.
Yeah, that's the issue of what is seen in that is which is not seen. It is easy to, both sides of the argument, both sides can say we only have that 3% growth because of the EU, and the other side,
or because the EU is such a disaster area that everyone's come from the EU and is operating in the City of London.
There's plenty of conjecture to be made as to where that growth rate would be without the EU, but that
was just another story.
Conjecture. Eurozone unemployment. On the other side of the coin, making that argument for the people who want to get out of Europe is, we have 5.5% In the UK, in the Eurozone, it stayed steady at 11.1%. I mean, it's come down from 11.6 this time last year, but that's not exactly a huge kind of strengthening of labour markets in Europe.
So still dodgy, ropey, etc.
Exactly.